All right. Hey, everybody. Thanks for tuning in to another episode of BlockFi Live. We have an incredible guest with us today, and not someone that speaks publicly too frequently. So we're really lucky to have him on and get to hear his thoughts. John Pfeffer is a multi-time entrepreneur, former partner at KKR, and one of the voices that I think has been instrumental in helping to facilitate institutional adoption of Bitcoin throughout the course of the last few years. He's also somewhere a lot warmer than me. So maybe to start, John, hi, thanks for joining. Where are you? Where are you right now? It's warm.
It's a pleasure. I'm in Uruguay, where we set up a base here 27 years ago when we moved from Buenos Aires to Brussels. Fantastic country, and it's of course the inverse season, so it's March, which is late summer, early autumn, and it's beautiful.
That's awesome. Well, for folks who aren't familiar with your background, could you maybe give us a quick introduction to your career and what you've done professionally throughout your career?
So I'm first and foremost an entrepreneur, and our family office, what we've done, I say my family office is my wife and I, we've tried to build, and we have built a business to scale every 5 or 10 years since the 1980s on my own, and then since the 1990s together with my wife. In the video business, the industry, tech in the 90s in France, and then I was a partner at KKR in the 2000s, and then built something in oil and gas, and now we're building a traditional retail business in Europe, based out of Luxembourg. And as we've exited these different businesses over the years as well, and have a portfolio that we invest in risk assets globally, private equity, public equity, and venture capital. So we see a lot of different stuff, and deliberately on the investing side, try to be adventurous and diversified in what we do.
So talk to us a little bit about how you discovered Bitcoin. Was it the investing efforts from your family office? And maybe tell us a little bit about that, story of discovering Bitcoin and what you initially thought of it.
So the first time I heard about Bitcoin, and this is like the greatest regret of my life, was April 2011. And it was, when it was presented to me, it was kind of like, oh, this is interesting, but almost in a kind of a little bit of this is kind of an interesting little experiment. And it was somewhat of a dismissive presentation. And I thought it was interesting, but it was also hard at the time, and I do a lot of stuff, and the friction was just kind of too great. And again, it wasn't presented to me in a way that I frankly registered it enough. But that was first I heard about it. And then of course, very casually from a distance, it was buzzing in the background. And remember, this was, a lot of things going on. It had its own pattern, and there was, GOPS and all these other events that were happening. And I was kind of like a layman, sort of a man in the street watching it a little bit, but not even with that much focus. And I had the tremendous good fortune to have coffee with Vinces Casares in Chile in 2016. And Vinces explained it to me in the simplest terms, and it was in 15 minutes. And it was just, look, money is a ledger for keeping up with what we owe one another. Bitcoin is a better technology for maintaining that ledger, because it's for the first time it works without a trusted middleman, a trusted arbiter, and therefore is the first decentralized digital money. And it'll probably fail, but if it works, it will by definition be very valuable. And it sort of clicked. I said, this sounds like the venture investing that we do every day. And you have an idea, it'll probably fail, and you just have to think about, sure, you want to think about the likelihood of success, but you also want to think about, if this thing is successful, is it going to be super valuable? And it was fairly self-evident that would be the case if it worked. And I immediately decided, I said, well, great. So we should do, what we call a venture line, meaning a venture, sort of that we would normally invest in a single early stage company. And got up from the coffee, and sort of as I was walking out the door, rang the office and said, guys, we're going to allocate X% of AUM to Bitcoin. Let's just do it. And I remember they were like, what, but, Bitcoin, what, and I said, guys, I never said this. I said, guys, this is a ready, fire, aim investment because it's liquid. So we should just do it. We'll learn more as time goes on. We can always upsize or downsize. Worst case, it's a venture line. So, it's not gonna set us back too much. But, let's just get some exposure. And basically, as a consequence, bought our, that was our buy back in 2016. And so it all went as many people do.
Yeah, I've fortunately had the chance to speak with Wences as well, and I think maybe more than anyone else, he's convinced an incredible number of influential people to get involved in the sector. So you bought sometime in 2016, and I don't think it matters when, because regardless of when you bought in 2016, 2017 must have been a phenomenal period of time in terms of performance for the investment. And I would also imagine that maybe because you did your ready, set, fire strategy, you started researching and developing more of your thesis after purchasing it, and then maybe seeing the market validate that in 2017. So how did, maybe over that first year or throughout the course of time, how has your perception changed about Bitcoin and what it's accomplishing versus that kind of initial thesis?
So what happened was, so at January 17, the price started to go up like meaningfully, right? It's like noticeably from, now I'm looking back and it was nothing, but you from normal life, it was like, wow, that's a big run. I need to read about this some more. So I started reading, all this stuff, and it was smart contract this, and virtual world computer that, and fat protocol this, and all this stuff, right? And I said, wow, that sounds really interesting and makes some sense. So we bought some ETH, and then things just kept going bananas. And I said, well, this is actually now kind of an outsized position on our balance sheet. I need to kind of dig in some more. And I started to realize, and this was probably now about April of 17, that everything I was reading, all the sort of what I would call secondary information, all the kind of perspectives and views and analysis on the internet was nonsense, basically. And that the only way I could form a real view was to go back to primary information and proceed from first principles to form my own view, which it's kind of obvious, but actually takes time, right? And so I started back, and I literally went back to reading, I said, I'm going to ignore all these opinions and read white papers and homestead documentation and think about it from my perspective, which is from one with an economics and finance and investing background. And again, think about not so much whether this stuff will be successful, because I have views on all of that and so forth, but my views are probably not differentiated. And there are lots of people who are as strong or stronger than me technically, but importantly, if it's successful, if these technologies are successful, will they be valuable and why? And so that was a big focus of my sort of the way my way I came at the question. And I spent sort of Q2 17 doing a lot of that kind of reading, and actually wrote the paper. It was fun. I wrote it on like in a little like, I wrote put all the ideas together in a little notebook in the back of a vehicle with my family driving around Anatolia, so sort of deep, all through Turkey and so forth. And then we sort of hung out in August at a hotel while a couple of our kids were doing an internship, and I wrote the paper. So it was August 2017 actually that I wrote it. And I wrote it not thinking I would ever publish it, but thinking of it as this is sort of our, I told you, it was a ready, fire, aim investment. This was sort of the aim part. So I was writing the investment memo to self, a year later, as to why we were doing this and what we should do. And if you read the paper, I came to the conclusion that that basically the value capture in this technology is actually kind of structurally pretty bad at value capture, and my perspective it is, and one important exception, notable exception, was store of value money as an application of this technology that by definition would capture value, and the implications of that were that we should rotate our portfolio. And so we started, exiting basically between maybe September 17 and January 18, all the non-Bitcoin stuff, and kept our Bitcoin, basically. So that was the story. And then what's funny is, I should say, so how did the paper get out? I shared it with some friends, and I said, guys, am I nuts? Could you just look at this? People who I knew more about this topic, and so I said, this is my view. What what am I wrong? But I said, but just keep it to yourselves. This is internal. And in November, I got this phone call from a very prominent person in the world of finance, and saying, "Oh, I read your paper. I love it. I want to ask you some questions." And I'm like, I know who this person. I knew this person, but I knew who they were, because that's the kind of person you have to Google, but I'd never met them. And I was like, okay, so someone's been handing apart, leaking the paper. And I said, well, in that case, let me clean it up. And so I did sort of a cleanup edit. I mean, a cleanup just in terms of preparing it for external use and as opposed to internal use. And happened to finish it and publish it. I think it was the 27th of December, 2017, which had nothing to do with when it was written. I mean, it would have been not much. I mean, it was months later. But that's why, because it was already sort of circulating, and so there's probably like a bootleg version out there, which was the original, but said the same thing.
So in case anyone isn't familiar, the paper that John is casually referring to as an institutional investor's take on crypto assets. And I remember reading this, and I don't know if I probably got the official version. I wasn't cool enough to have anyone sending me the bootleg, not ready for prime time version. But I remember when this came out, I think it was eye-opening for a lot of folks, because it was the first time that something had been put into the context of how institutional capital allocators frame their investments, and you very thoughtfully kind of constructed an investment case for Bitcoin. And I'd be curious to hear, so you had someone super influential, reach out and talk to you about it. But then after you published the official version, then what happened? And maybe if you've seen any of these, theses that you presented in that paper start to play out over the last couple of years.
So it was funny, it was explosive. I mean, it got read a lot. It was like translated into different languages and all. It was not something I was accustomed to, but great. And it gave me, and I was happy to try to be a bridge between the institutional investing world and this great investment opportunity, which I'm still have tremendous conviction in, perhaps more than ever. In terms of how it's played out, I mean, one of the reasons that there's a couple of reasons that I haven't published other stuff, or there's like one other small thing I published, and I've done a couple of podcasts, is, to me, nothing's really changed. I think that the views I expressed, I certainly still hold to them. I think they still apply. I mean, there's some new things that you can somewhat maybe constructively apply the principles to, that I didn't explicitly do, or not in a lot of detail in the 2017 paper. But the basic concepts, I think, apply and are playing out. I remember the time that was the height of, there were two big things that, I don't want to sort of simplify 2017 because it was an incredible year in all kinds of ways in the space. But you had on the one hand the ICO boom, and it was all about utility protocols and fat protocols and all this kind of stuff. And that I basically, the conclusion was, if all this works, I don't think it's going to be terribly valuable. And there was the block size war, right? And so there was a little bit of questioning about store of value versus means of exchange, and kind of which was the more valuable thing, and how would that play out, right? And so that was the view then. And I think if you look at what's happened, the ICO, we've moved on, and so now there are other hot areas, and I don't want to necessarily conflate them because they're not structurally the same kinds of things. I can give you my thoughts on them in a minute, but I don't want to say that a utility protocol is the same as an NFT, because they're not, right? You have to think about them in completely different ways. But the point being that the fashion has moved on. But broadly speaking, except for Ethereum, the utility protocols have really failed to capture much value. And Ethereum, I think the jury is out personally, but we'll talk about that, I'm sure. And on the store of value versus means of exchange point, I think it's fairly clear that the world has agreed that store of value is the most valuable use case and the thing that drives it, and that means of exchange is a satisficing, not a maximizing feature of a store of value, right? And that's some of the things I talked about in there. So to me, my opinion is that the world has played out consistently with the views in the paper, and I haven't really changed my views as a consequence. And I would add that it's what I described in the paper was sort of a long view, and so we're still in the midst of it. One of the things that when I think about, I would say that the kryptonite of crypto is real world usage, and I think that we're still very much in a speculative phase where things, there's Bitcoin, and then the rest of it, there are things that have value at a moment in time, and it's kind of a changing, there's a wave of it's this thing, and then it's this thing, and it's this thing, and these themes that arise and they fall. And if you go back and look at the top 20 crypto assets and the turnover in that set, apart from Bitcoin, it's pretty massive. Certainly, if you zoom out enough years, but it's still all quite speculative, right? It's people just buying stuff and trading it based on some kind of expectation. And part of the thesis that I lay out in the paper is that one of the fundamental problems is going to be that a lot, anything that is effectively that users are going to adopt and treat as working capital, as opposed to a way to store their wealth, is actually likely to not be a great, is not going to capture a lot of value. And because no one's really doing a lot of real world stuff on these protocols yet, we still haven't really come to that end game. And I think that, and that's not surprising. It could take it could take a number of years more. And as a consequence, there's this, I think, separation, at least in my mind, of what the speculation is and then kind of where things are going to end up. And I'm personally one of those people who's much better at sort of investing than trading and thinking about things in the long term than the short term. So I don't even try to worry about what's going to be, what the relative performance of some of these things over the next 3 weeks or whatever is going to be. But if I had to, when asked, what do I think is going to be the end game, it's the same as what I outlined in 2017, in my view.
Are there things that have given you maybe more conviction in some of the theses that you laid out, or have you seen certain adoption trends accelerate, maybe as a result of COVID and broader set of events that kicked off, either that surprised you or didn't surprise you? And I'm thinking about things like companies holding Bitcoin on their balance sheet, or some of the big macro investors coming out and planting their flag a few years after you and saying, right, here's my view.
I think, again, it's I don't know, it's been interesting to see it play out as I would have hoped. I guess maybe in 2017, I would have optimistically hoped that there would be institutional adoption, like thinking like in 2018. But the infrastructure just wasn't there, right? I mean, there wasn't, the BlockFis of the world weren't up and running at the scale and sort of the on-ramps and the services and everything that are required to support that kind of influx. But now it's there, and boy, the sector has built it, and they have come, and they're coming, at a pace and scale that is, again, on the one hand, maybe I was expecting or predicting at some level, but seeing it happen is pretty exciting, for sure. Now I think there's sort of a consensus around the fact that if you're going to have a valuable crypto asset, it has to be a store of value, effectively, and kind of thinking about it in those terms. And that's something that has been interesting to see how everyone has gelled around that idea, which I think is right, and it's not surprising to me, but it's a shift in terms of what was maybe then was a normative statement has become the case.
Yeah. Well, you're someone that thinks a lot about investing, and you're very international and global in terms of your lifestyle. What are your thoughts on stablecoins, and how these maybe interplay with Bitcoin as a store of value, or just interplay with kind of FX markets and global money flows?
Well, let me zoom out maybe. I mean, so if you kind of think about the whole space, right, and you've got what I'll call sort of things that are trying to be money, right? And when I say that, I'm gonna separate stable coins from that for a second, even though they're obviously trying to be money. But new protocols that are trying to be money. Then there's stable coins. You've got NFTs. You've got securities tokens, and you've got utility protocol tokens. And some of the DeFi, and I think actually like a lot of the DeFi stuff, you can actually push, if you just kind of turn the crank once, it's either sort of a securities token or a utility protocol, at its, if you just push it a little further, right? So probably things roughly fall into these buckets at the moment, and maybe something new comes down the pike. And my conservative view would be on stable coins is that they are going to coexist with, so I think Bitcoin has is in a tremendously powerful position to be the dominant store of value, decentralized digital money, right? At this point. But I do think stable coins will probably coexist and will be used both for payments and to some extent for store of value, right? At least for some time, if not always, and I would probably conservatively assume always. And I do think this analogy of thinking about Bitcoin as kind of digital gold is it's a bit of a cliche, but it's true, right? And gold coexists with the dollar and the euro and so forth. And I think that's actually a pretty, it's pretty easy to imagine that world, and therefore there's a reasonably high probability that world materializes. And then the question is, what happens to those individual currencies over time? Does the dollar collapse? Because it gets debased and so forth. Well, maybe. Will there then be some other fiat? Maybe. I don't really know. But so I think conservatively, I would assume they coexist. That Bitcoin is this non-sovereign, dominant non-sovereign store of value, and then there'll be different sovereign stores of value / means of exchange protocols. I think their development is great for Bitcoin because it helps move, it's an on-ramp and an off-ramp. It helps move everything into protocol land, and so their development makes a lot of sense to me and is very positive. As an investor, I, to be honest, don't think about them that much because you can't make money off of them. Real money, right? I could buy some, some and lend it to BlockFi, I guess, but that's okay. It's a fixed income investment, which isn't what I really do. I'm more of a risk investor. So that's my view. I think they're really great and important. They'll probably coexist. there's a chance, there's a timeline out there where hyper Bitcoinization does occur. I don't necessarily feel that you need to apply. I mean, whatever your view on that is, you don't necessarily need to apply a high probability to that timeline for Bitcoin to be a phenomenal investment. And if and as a consequence, when time goes forward, if it's already will have been a phenomenal investment, and that probability will still exist. I mean, there'll still be that potential future, and that will be further upside as a for an owner of Bitcoin. And if it doesn't happen, it will still have been a great investment.
Yep, I think our views are very much aligned there. I definitely see it as a big net positive for Bitcoin that you've got these stable coins helping to facilitate on and off ramps for folks. Is there anything happening in? I know your time is super valuable. We only scheduled a half hour. We're almost up. Is there anything other than Bitcoin that's happening that you are excited about in the crypto ecosystem now, or any trends you're starting to see with NFTs or other things that maybe weren't around back in 2017 that you think will help drive adoption or are just fun or interesting?
There's a lot of fun, interesting things. I mean, I want to be careful here because I'm when I'm investing in venture, I'm an optimist, and I believe in human innovation, and I think one of the most soul destroying things to do is to question or minimize all these innovations. Now, the next question is what I want to invest in, and to me, like the most, like by far compelling risk return in this space is to just buy Bitcoin and hold it, right? That to me is sort of the unbeatable case. That's what we do. Okay. Now, what do I think about these other things? I think there's a lot of interesting stuff. So very quickly, I sort of mentioned these different things. I think that security tokens are very interesting, but here's the thing. In the end, it's really just a back office improvement, right? And it's not clear to me that the value capture of the protocols outside of the actual securities, which already frankly exist or would have existed, right? And so to kind of split that value out is going to be that important because, well, one, as soon as you need to enforce ownership in the real world, you're basically going back and you collapse back to a centralized environment because you need a court or a legal system to enforce it, at which point paying the cost of and it's necessarily costly to have a decentralized protocol. Decentralization is necessarily costly. We can, because that's the solution to the Byzantine general problem, and that's how proof of work worked. And that, so I mean, that kind of going back to the technical side, it actually needs to be expensive, right? I mean, this is not a technology that you apply for efficiency and speed. You apply it when you value decentralization enough to pay up for it, right? And ultimately, if you've got to enforce ownership in the real world through some central intermediary, I'm not sure it's worth paying for the decentralization. So I think a lot of that collapses back onto basically, databases in the end. And if it does migrate, to some extent, I think that those things will be again working capital. The protocols that enable that will sort of be working capital. I don't think they're going to be great at capturing a lot of that value. Certainly not relative to kind of current crypto valuations in general. NFTs are fascinating. And right now that's like the hot thing of the moment. I have the good fortune of being an early, we at our family office have the good fortune of being early investors in Dapper, the maker of CryptoKitties and all of that. Yeah. I think it's all fun and interesting. Now, what do I think about this? So I'm going to get slightly technical here. Again, if the blockchaining of the thing is just to have a certificate of ownership of a physical world thing, I'm not sure that really kind of makes sense in the long run because you still got to enforce it through, imagine you buy a blockchain certificate of Picasso, all right? You're still dependent on the Picasso Foundation saying this is a real Picasso. And you need to go, that painting has to sit somewhere and you've got to enforce your ownership rights through courts. Is it really changing things for you to have this thing on some decentralized protocol? I'm not so sure, right? Having it on a database and therefore tradable, maybe, but that's different from, you can do that much more cheaply without a blockchain, right? Now, and the difference would be something that is purely digital, that is truly digitally native. And I think that could happen. I think you could see it. I think the question will be, are users willing to pay up for the decentralization? In gaming, are they going to want to, and I think the answer is probably not much. I think they're probably going to be willing to trust central intermediaries for a lot of stuff. And so I don't know really what the TAM of that is when it all shakes out. But clearly right now it's a hot thing. I think that's great. I mean, I think it's all fun and exciting. But, when you really kind of drill into it, so take this thing that just happened with the Beeple sale, that's absolutely amazing. But as I understand it, and please correct me if I've misunderstood, because I haven't spent vast hours researching it, but you've got a digital certificate that tells you that you own a JPEG, but they're actually two separate things. So, and that's not a problem, but the interesting thing about that is that you still have this sort of dissociation. It's not truly digitally native on the decentralized protocol. And in the end, how compelling is that? I'm not entirely sure. But I think the thing to focus on would be things developing which are truly digitally native, on the decentralized protocol that are truly unique. Okay, I think there could be something, but I think there's going to be a little bit of a sifting through of these distinctions as time goes on, as people get more sophisticated thinking about these differences. And I continue to think that utility protocols are going to just be working capital that is going to fade into the background, like electricity in the walls, and won't be tradable assets. They won't be traded assets. There'll be things that you just consume, and there'll be bots that kind of deal with that, and therefore velocities will go through the roof, and they won't be great at capturing value, independently of how much value they might create, like in terms of surplus for users. So the consequence of all of that kind of long explanation is that I still think that store of value money is the most compelling thing. And interestingly, although the price has gone up a heck of a lot since 2016, if I would look at my expected value, i.e., what I think it could be worth multiplied by the probability that it actually gets there, is probably higher today than in 2016. If you understand what I'm saying, meaning I think the probabilities of success have risen faster than price. And so I think today it's an even more compelling investment than I did in 2016, as we stand today. And I'll talk about Bitcoin specifically.
Yeah, that makes total sense. So last question for you, John. Outside of Bitcoin, in the other risk assets that y'all like to look at or invest in with your family office, what are some of the other categories or things that you're excited about?
So that's a great question. As you can imagine, I mean, look, I'm sort of like, maybe, I don't know if low key is the right word, but we'll call it low key singularitarian, in the sense that I do think that we are living by far the most interesting time in human history. And I'm going to call it 3 decades, just from the acceleration point of view. There's like G forces that we're going to experience over the next, say, 30 years, and maybe it's 20, maybe it's 35, but that kind of time frame are unimaginable, right? And yes, we could be a little ahead of ourselves on tech valuations, but even if we are, that is the thesis over the next the next few decades. That is the thesis in my view, is exponential technology, and all of its implications and different ways to capture value. And obviously, the reason we love, when I told you what we invested in, I said venture, private equity, public equity, and venture. It's all equity. That's because equity is the instrument that captures the value of human ingenuity, right? And so that, when you say, well, I'm betting on exponential tech, what you're betting on human ingenuity, and equity in all of its forms captures that. And provided you have enough of a long enough investment horizon and a stomach for volatility, you're always going to do better, in my view, being long those things, right? And we have the benefit because it's family money. So no one, my wife, my money, and my family's money, right? My nuclear family's money. We could, no one can fire me. We got enough we're not gonna suddenly, go hungry. Fortunately, if it takes a few years for things to bounce back, and so that's a huge strength of ours, is that we can then leverage that into being exposed to these long-term trends. And I think that's kind of like the no-brainer. And that doesn't mean that also in parallel we don't do some traditional markets investing, like, we're going to have a cyclical rebound right now. So what's a great expression of that? Well, I actually like, as a great expression, a levered expression of a cyclical rebound, the listed private equity stocks like KKR or Blackstone, right, where you're sort of triple levered real economy exposure. And fine, we'll allocate to that. We'll also, I like private equity as an asset class. It's one of the most predictable high return assets. We do a lot of that. But the stuff I spend time on is really this exponential tech, and so and trying to get exposure to that at all stages of sort of of company life cycles. And I think when we think about how we're going to focus our time going forward, it's just, how do we do that more and even better as time passes? How do we become even better tech investors as the years and next couple of decades pass?
And just because I'm curious, is there a particular type of exponential tech? Like, are you talking robotics or space exploration or stuff in the clean energy category? Like,
so I mean, I'll give you it's a really good question. So I was actually sitting in this very spot, not a little over a year ago, and I hope I'm not with Kathy Wood.
Because you sound a lot like, I was going to mention Kathy's name just based on how you were describing.
So Kathy's, I personally count Kathy as a friend. I think she's phenomenal. We certainly share the same thesis, and she's brilliant in terms of, her institution ARC's research, I think, is fantastic. And she's obviously taking a hit right now, and I couldn't care less, because the thesis is right. And it's just, this is just, you got to zoom out. The interesting thing about what you said is, so which of these different exponential technologies do you focus on? I think you kind of all of them, but they all boil back down. Interestingly, most people talk about Moore's law, but actually it's Wright's law that underlies Moore's law, right? The true exponential. I mean, there's nothing more powerful in the universe, obviously, than exponential, compound interest, and all that, right? So you want to, this is like, and the ultimate exponential is actually Wright's law, which is the experience curve, right? Which is that that you get, you do stuff better and cheaper at some exponential, at some exponential rate as you double the units produced. That's basically what is creating Moore's law. I mean, Moore's law is just a derivative of that. But we're seeing that across so many different things. So yes, Moore's law is, you look for anywhere where Moore's law is at work, and Wright's law first, and then Moore's law through that. And there's so many different things. But even take, for example, we invest a fair amount in genetics. And what's going on in genetics is we see that the cost of sequencing is falling even faster than Moore's law. But that's because it's not, you've got these different pieces of the cost of sequencing. You've got obviously the actual kind of liquid chemistry of reading the DNA. You've got the processing, which is obviously very much Moore's law, and you've got the storage, and interestingly, these other things are even progressing faster than Moore's law in terms of bringing the cost of sequencing down, with all kinds of implications. It's just one example. We've just lived, I think, 2020, the most exciting year in human history. And I mean, obviously, it was a very difficult year in many respects, to state the blindingly obvious. But in terms of innovation, it's unbelievable. Not to mention, the fact that they had an mRNA vaccine within 48 hours or whatever. I mean, this kind of stuff is amazing. But and the implications of that, and so many different other applications. But the pace of innovation is so incredible across all these different fields. So, I'll answer your question. So it's clearly software, bioscience, so biology, space, with launch costs coming down, and the implications of that, and material science, yes, robotics, AR, VR, different kinds of computation, sort of next, quantum compute, and these kinds of things. And there's so, and we try to be exposed as much as we can across all of these things. And they're also exciting. It's unbelievable.
That's awesome. Well, this was a phenomenal interview. Thank you so much for sharing your thoughts with us, John. We really appreciate it. If you haven't seen it, we're going to link to John's original An Institutional Investor's Take on crypto assets in the show notes. And I hope you all enjoyed hearing from John, who's one of the smartest folks in the game. Take care.
Thanks, Zach. It was great.